On the 6th of April 2026, HMRC quietly put the basic rate of dividend tax in the United Kingdom up from 8.75% to 10.75%. That is 2 percentage points on the headline, but because of how percentages work, that is actually a 23% relative increase in your dividend tax bill. Higher rate taxpayers are paying nearly 2% more too. Today I'm going to show you exactly what changed, exactly how much it costs you with real worked examples, and the 3 ways to legally avoid most of it. The strange part is that the dividend allowance, the amount you can earn in dividends before any tax is owed, did not move. It is still £500 a year, which means everyone above the smallest dividend earner is paying more this year, regardless of their tax bracket. And almost no one in UK finance media is talking about it specifically. So let us go through this carefully because the numbers genuinely matter for anyone holding dividend stocks outside a tax wrapper. Quick one before we go further. This is not investment advice. This is not tax advice for your personal situation. Always check with HMRC or a qualified accountant for your specific circumstances. Tax law also changes, sometimes mid-year. The numbers in this video are correct as of late April 2026. Right, here is what actually changed. From the 6th of April 2026, dividend tax rates went up by 2 percentage points across all 3 bands. The basic rate moved from 8.75% to 10.75%. The higher rate moved from 33.75% to 35.75%. The additional rate moved from 39.35% to 41.35%. The £500 annual tax-free dividend allowance, which is the amount you can receive in dividends each year before any tax is owed, stayed at £500. It has not moved. It used to be £2,000 back in 2017. Now it is £500. So the rate went up, the allowance stayed flat, and the net effect is that everyone earning dividends outside a tax wrapper pays more this tax year. Let me show you what that actually looks like. Imagine you hold a fairly modest dividend portfolio outside a tax wrapper, paying you £5,000 a year in dividends. Last tax year, you would deduct the £500 allowance, leaving £4,500 taxable. At the old basic rate of 8.75%, that is £393.75 in tax. This tax year, the same £5,000 in dividends, same £500 allowance, but now taxed at 10.75%. That is £483.75 in tax, £90 more. From the same dividends, just because the rate moved. Now scale it up. A higher rate taxpayer earning £15,000 a year in dividends outside a tax wrapper. Last year that was around £4,893 in dividend tax. This year around £5,183. £290 more in a single tax year. The bigger your dividend income outside a tax wrapper, the bigger the absolute increase. And there is no announcement that the rates will go back down. Once they are up, they tend to stay up. Quick one. The single best way to avoid this entire change for any UK dividend investor is to hold your dividend stocks inside a stocks and shares ISA. The dividend tax rate inside a tax wrapper is 0%. It always has been. The tax hike does not touch you. If you missed last week's full ISA explainer, the link is in the description and the pinned comment. If you want to follow this entire journey of building an actual UK dividend portfolio inside a tax wrapper, hit subscribe. Now back to the 3 ways to defend against this change. Fix number 1, and by far the strongest. Move dividend stocks inside a stocks and shares ISA. Every UK adult gets a £20,000 annual allowance. Anything you contribute lives inside the wrapper. Dividends are tax-free. Capital gains are tax-free. No tax return needed. If your dividend stocks are currently held outside a tax wrapper in a general investment account, you cannot simply move them across without selling first. You sell, transfer the cash to your tax wrapper, and rebuy. That triggers a capital gains tax event on the sale, which is something to think about timing-wise. But on a forward-looking basis, every new contribution should go into the tax wrapper before any general investment account. Fix number 2, the self-invested personal pension or ASIP. A SIP also pays 0% dividend tax inside the wrapper. The trade-off is access. SIP money is locked away until age 57 currently. So if you are saving specifically for retirement, the SIP gives you tax relief on the way in plus tax-free growth, which is genuinely powerful. For income that you want to access flexibly before retirement, the tax wrapper is the right tool. Most serious UK investors use both for different goals. Fix number 3 is partial and strategic, rather than complete. Dividend tax is calculated based on when the dividend is paid, not when it is declared. So if you are sitting close to a tax band threshold and you control your other income at all, the timing of when dividends fall can shift them between bands in a way that reduces your overall tax. This applies more to small business owners taking dividends from their own companies than to passive investors holding listed shares. But for those it applies to, deferring or accelerating a dividend payment by even a few days across a tax year boundary can save real money. And quick note on what this means for the channel. Every single share I have bought across the first 3 months of this journey is held inside a Trading 212 stocks and shares ISA. So my dividend tax bill on the £7.36 landing on the 4th of June is exactly £0. That was the design from day one. The 2 percentage point rate hike does not touch this portfolio. It would, however, touch every dividend earned outside the wrapper if I had been careless about how the account was set up. The tax wrapper is not just a nice tax break. It is the structural difference between paying 10.75% forever and paying 0% forever. Multiplied across decades, that is enormous. And bigger picture for a moment. Why did this happen? The UK Treasury needs revenue. Dividend taxes are politically easier to raise than income tax or VAT because they primarily affect wealthier savers and investors rather than wage earners. The £500 dividend allowance has been cut twice in the last few years already, from £2,000 in 2017 to £1,000 to £500 today. The rate has now moved up too. The trend across the last decade is clear. Investing outside a tax wrapper has been getting steadily more expensive. Inside a tax wrapper, nothing changes. That gap is widening deliberately by policy. The lesson is to make sure you're on the right side of it. 3 quick actions for anyone watching. 1. Check whether your dividend stocks are currently inside a tax wrapper. If you're not sure, log into your broker right now and look at the account type. It will say either tax wrapper or general investment account. 2. If they are outside, plan a switch. Sell and rebuy inside a tax wrapper across the right tax year boundaries to minimize the capital gains tax cost. 3. From this point forward, every new pound you put into dividend investing should go inside a tax wrapper unless you have a specific reason not to. The default has changed. And to put a longer-term number on what this means, an investor with £20,000 of dividend stocks outside a tax wrapper, paying a 5% yield, is now paying around £107 a year in dividend tax that they were not paying as much of last year. Over 30 years with reinvestment compounding, that is several £1,000s of dividend income lost to a rate change that is, frankly, painless to avoid. Inside a tax wrapper, the same portfolio pays £0 of dividend tax over those same 30 years. The cumulative gap is the entire tax wrapper case in miniature. And one prediction looking forward. The dividend allowance has been cut 3 times in the last decade, from £2,000 in 2017 to £1,000 to £500 today. The rate has just been raised by 2 percentage points. If the pattern holds, expect the allowance to be cut again in a future budget, probably to £250, and possibly another rate rise behind that. None of these moves require legislation that touches inflation-linked income tax bands. They are politically easy, fiscally meaningful, and they pull in the direction of more tax on dividends paid outside tax wrappers and SIPs over time. The rational response is to make sure your dividend portfolio is structured to be invisible to the change. And one thing worth flagging because it gets misunderstood a lot. Dividend tax does not apply to the value of the shares you hold. It only applies to the cash dividend payments you actually receive in a given tax year. So if your dividend stocks pay you nothing one year, you owe nothing in dividend tax that year, regardless of what your portfolio is worth. That is the basic mechanic. The new 10.75% rate is a percentage of cash you actually received, not of paper holdings. So the practical impact is felt by anyone whose portfolio is throwing off real cash dividends outside a tax wrapper. For most retail investors building income portfolios, that means yes, this hits you, but only if you have not already sheltered the holdings. That is the 2026 dividend tax hike, what changed, what it actually costs, and how to avoid most of it. 2 percentage points on the rate, 23% relative increase, £500 allowance frozen. The fix is the same as it has always been. Use the tax wrapper. Use the SIP if it suits you. Pay 0 on dividends inside the wrapper. If you want to follow this whole journey of building a dividend portfolio inside a tax wrapper, fully sheltered, subscribe. New episode every week. Now I want to hear from you. Were you investing inside a tax wrapper already? Or has this change just woken you up to it? Drop it in the comments. The answers genuinely shape what I cover next. Until next time, happy investing.